that's the answer, right? We're gonna be real efficient on the tax side, we work within the rules, but do all that we can to deduct it and get it down. Let's make the burn on the tax side as low as we can. With the good news that's coming that with Ethan's help, you're gonna normalize it back up to what it really ought to be in a plane, in a go forward. So you get it both ways.
I think you said on the valuation that it's the gross and not the net that you take into consideration.
So it is,
In that respect.
right, it is net cash flow. Net cash flow.
Okay.
So it's the cash flow that would be available to an owner, basically what the company could distribute out to the owner at the end of the day.
So they could
Yep.
write off their cell phone and their car
Yep.
and their.
And after, the provisions that are set aside for future investment in, machinery, equipment, and making sure there's enough money in the bank account to make payroll, make sure all that's set aside, what's left over.
Question. So, you called that a normalized valuation,
Normalized financial statements.
Okay.
Yeah.
thank you.
Question, what do you do with a company's cash assets? Let's say, you just mentioned, there's enough money to make payroll. We like to leave a nice cushion, $500,000 or something there. Is that more valuable to stay in the company and be valued up in terms of an asset, or is it only worth what its paper value?
Yeah,
Is it better to take it out, extract it, and leave the company basically naked?
that's a great question. So from a financial, personal financial position, always better to take it out and invest it. You're going to get a higher return by taking it out, right? Don't let it sit in the checking account.
And liability-wise as well, you're keeping inside of the company subject to the company liabilities.
Mm-hmm.
Yeah. And for valuation purposes, what happens is we look at what a normalized or a necessary working capital level is, and working capital is basically the current assets, the cash, accounts receivable, inventory, minus current liabilities, the accounts payable, bills, everything you need to pay in the short term. We look at what is necessary to keep in that area, and any excess is considered a non-operating asset. It's really not adding or necessary to the operations of the business. So it's sort of set aside, and then we just put it back at the end of the day. So when we're valuing the business, we value the operations, how much is the business worth from an operating standpoint, and then we look at the non-operating assets that are there. You see all sorts of things. Sometimes I've seen condos that are held, that are investment properties in the business. You would add that because that's part of the equity, it's, of the business.
Mm-hmm.
And
Especially with the C Corps.
Mm-hmm.
If you have a third-party buyer as opposed to an inside or a family buyer, though, having some cash reserve is important to them from their perspective, when they look at purchasing the business. I've been involved in a lot of deals where there's been negotiations about the owner sweeping the cash before the closing happens, and the buyer saying, "Whoa, we valued it based on there being operating revenue. Otherwise, we're going to have to come and put more money in." So there's, don't leave too much in, but if you have some that you can leave in comfortably, it'll be helpful when you go to sell.
Is there a formula, for example, let's say you have an $80,000 payroll every 2 weeks, $160,000 a year, a month. Is there a formula that would say we maintain 2 or 3 months payroll?
Yeah, I think typically that's what I hear from buyers, representing buyers, is like they want a couple, 3 months, sometimes 6 months of coverage in there. They might fund some. They might ask the owner to leave some in there. That's usually a negotiation, because the owner say, "Hey, I earned that cash. I pay taxes on it. I'm sweeping it before I close this thing."
Well, if you leave it in, it actually should improve your valuation by a multiple, because it becomes then net return never realized. But it should be reflected in valuation.
A little bit maybe, but it's maybe by the amount of it. I don't think by a multiple of it, because the multiple really goes on either gross revenue or net cash flow. What's coming in all the time. So, but
yeah, and sorry to interject here, but just from a purchaser standpoint, they're not going to pay more than $1 for $1 that's in the
They're
bank.
not. Okay, that's what I'm
Right. Even though it's part of the formula and it's built into your business that's being evaluated, the multiple goes against just the cash flow, not the static cash.
If this is evidenced by prior, accounting, doesn't that add credibility to the whole structure as far as the valuation is concerned? To show that you kept a cash reserve for 10 years?
Yeah, so it would certainly strengthen the financial position of the company, right? From a buyer standpoint, oh
From a
yeah, this thing
credibility
has no debt, and it's got a ton of cash, right? And it also gives you options as a seller. We've seen instances where some of that, maybe the buyer, it was to a key employee or a family member, they didn't have all the cash necessary to buy all the stock. So some of that excess cash was used to redeem some of the stock, and then it got it down to a level where the person buying it could handle the rest.
This is a typical scenario for C corporations. If there is a lot of retained earnings in the company can buy back the shares. Right.
Okay,
Great question, great
Got it?
questions.
Okay.
got it, got it.
So in this whole process, when it comes to the valuation of the company, you need to think about it. What is the value of my company? And if you put yourself in the shoes of the buyer, like what is the rate of return on a purchase? So if the rate of return is less than a 10%, then probably is not going to be a good sale for you and not a good buy for a buyer. We come across the business owners all the time, especially me and Charles. Like we have a prominent business owner local here, a lot of retail stores, like household names. When we sit down with him, he wanted a certain amount of dollars, but when we look at the financials, we come out that he's actually 7% net profits. 7% rate of return on an X amount of dollars that he want to sell it, it's not going to fly. So we assess the whole situation, we look at all the numbers, we give them some pointers, and guess what? He's at 15 right now. So now he's looking more appealing because we went back, reshuffle everything, cost of goods sold, everything. Pretty much the whole P&L was revamped over a period of time, and now he's at 15. So now he's looking like a potentially good sell.
No, he doesn't want to sell.
Well,
So I just double my
Well,
money.
yeah.
What am I doing?
Yeah, exactly.
So, but kind of cool, right? He's seen the value of it. He's experienced the value of it, and now it's actually worth what he manages, more closer to what he manages.
And he now has like more options. There's more people on the table that he can talk to
More breathing.
because he looks more sellable for this particular event. Any additional questions so far?
What kind of a budget do you need for appraisals?
That's a great question because a lot of time people have this idea that valuation costs a lot of money. So Ethan is going to cover that in a second.
Yeah, it does.
There you go.
Now, there's a menu of options, right? So we don't have to do the full formal, 90 to 100 page valuation, unless you're in a situation where you're probably going to be buying, or that valuation might be used by a seller, by a buyer to get financing. But if you're looking for, hey, I need to get my initial kind of gut check, where's my business at? There's a limited scope valuation that we can do, where instead of where we traditionally look at the business in a full valuation from 3 different perspectives, we might just look at it from one and say, hey, in this one we're just going to look at it in terms of the income approach, which is the cash flow that the business is generating. We think that's probably going to give you the best indication. And so we can start there and save on fees, and then down the road, if that needs to be expanded and updated, we can do that without much duplication of fees. So.
And what is the
And so for a calculation, rough range would be probably in the 3,000 to 5,000 range.
And you operate off of 5 years of financial statements, or what do
Yeah.
you need to make your?
Yeah, I think all of us.
Or do you come down
I think
and
all of us.
help?
We out the gate, we ask for the last 5 years of financials as a starting point.
So the process is like following. So when the people come in and talk to us, we are the first. We are actually quarterbacking the whole deal. So we are hand-holding the business owners from step 1 to step 7, and we pretty much help them go through the process, meeting with the different advisors. So once we start the process, the first thing is we sign the non-disclosure agreement. Then we collect the 5 years of all the financials, the personal financial statements. We look at your P&L, balance sheet, tax return, personal tax return. So we equipped ourselves with all the numbers. Once we have all the numbers in place, then we start with evaluation. We start with your personal financial planning, make sure that we know what the number is, what the gap is, right? And this quick valuation, what Ethan was talking about, that preliminary one, is a usually scenario that we go to. Why? Because they get a rough draft, they're not transferring yet, they have a 5-year mark before they want to get out, so we just want to see what the value is right now, so we know what we're working on, where we need to be in 5 years from now. So once we collect all the documents, then we talk to the CPA, then we talk to attorney. We also collect we do a legal audit, and Scott and his team pretty much review all the documents that you currently have on the shelf. That is probably this much of a dust on it because you didn't touch it for like 30 years. So that's a legal audit. We have like a tax audit, pretty much financial audit, valuation. So that's a whole process that we quarterback. I hope that answered the question.
Well, does that mean, Marco, that the idea is you start working with a company 3 to 5 years before there's any notion of sale, and you
Correct.
stick with this.
Correct.
This is a program, not a one-time snapshot.
Correct. It's not. It's
Okay.
pretty much it's to develop. There's 2 parts to it. So the first part is developing the business exit plan. That stuff takes like 60 to 90 days. And the plan is like making sure that you have a plan what's going to happen going forward. 9 out of 10 exit plans that we're working right now are internal transfers. Hawaii is just like that. This is the market. We don't have a lot of third-party sales just because of the size of the companies are lower end, right? So most of the companies are internal transfer, partners transfers, family transfer, whatever. So in order for a business owner to get out in 5 years, we start the exit now. Because it's an earn-out. Don't forget that it's earn-out. The business cash flow need to finance the deal, right? So we have a 2023 is your exit, you're done, but we starting now. So we slowly start transferring the shares. And we can give you the example of the business owner that actually came to us through Eaton. They did a valuation. Valuation came out at $2.8 million. He wanted 5. Just think about it. He wanted 5, 2.8. He can do it. Why? Because he's transferring to key guys in his company. He can ask whatever he wants. After we did the transfer, so after the valuation is done, we determine the cash flow, we figure out the numbers through it, and then he came to us, and then we designed the financial structure and financial transfer. Of course, Charles was involved. Scott is wrapping up the legal documents right now. We're almost about to sign. Guess what's going to happen? Because of the numbers and because we monitor year after year later, their financials are way better. So the guy is actually going to come out of this deal with $10 million. 2.8 the value. If he went to the third party, he will collect 2.8, pay the capital gain tax. He's going to walk away with like what, 2 million maybe less. Now, because we're structuring a 7-year plan, he's going to walk out with 10, and way less paid in taxes. But don't forget, why is it 10? Because his cash flow, his sales and everything went up. Why? Because he's not army of one anymore. Now he has 3 other partners. They're all motivated more than he is to actually work harder and make this happen. Just think about it. You're not only getting the potential buyer through these internal transfers, you're actually getting more energy in, because you have more people that will carry that business owner hat. So that's priceless. So we have another client that actually, that was a good story, and Scott was working on that, and I think Ethan as well. He offered it to 3 of his guys, and I told him, one is going to quit for sure. When you're offering to 3 people within the company that they didn't come to you and ask, you offering to them, one will quit. So what happened in this case scenario? One quit, one actually asked for more money and whatever, and eventually he left too. And who picked up the business after a while was the youngest guy in the pack. He was like 25 years old. Guess what happened with the business? The guy is so motivated, young, full of energy, he sleeps in the office. Because they're so busy now. The production ramped up 3 times since 2015 when we did this. It's crazy. So that's things that you cannot really illustrate to people, like through the numbers. And when we do financial transfer and show you how the number is going to flow through the number, that's something that you cannot really illustrate because that just happens. If you have the right people to transfer within the company, It's just like a multiple effect.
Take $1 million of net cash flow. Generally speaking, and I know it changes from industry to industry, what's your multiple on that for valuation purposes, just on $1 million?
Yeah, that's the question right there, the industry rules of thumb, so everybody's heard of
Is it
them.
8 times, 10 times, or 28 times like the stock market? I'll take 28.
Yeah. So this is when we start playing the Price is Right. Okay. So you know, you've got this business. You know, Bob Barker's or Drew Carey now is saying, hey, we've got this construction company. Here they are. They've got $1 million in revenue. They've got 200,000 in EBITDA. Similar to cash flow. And so what is the price, right? And everybody's got their rule of thumb in their head, and they're saying, oh, construction companies, there's a one-time gross sales or 2 to 3 times EBITDA, right? They've already got it figured out. But then Drew throws up the next business, and he said, okay, construction company, $1 million revenue, one general manager, one big client that makes up 80% of the revenue. And the list goes and goes and goes. And they're like, oh, yeah, there's no way I'm paying 1 times gross for that.
Yeah.
And it's because and so the rules of thumb, all rules of thumb are bad, right? They're out there, but they're just general, and so it really comes down to the characteristics of the business that are the factors that are specific to it. So.
Okay. And do you guys help locating for that 1 out of 10 actual third-party sales? Do you have contacts to help market and sell?
So I'll cover that. So a couple of things happen. Depends on the value of the business, and I will say most of the third-party sales, they need to be over $1 million in EBITDA. We have a contacts in relation with M&A firms. Unfortunately, here in Hawaii, we don't have many. Handful companies that can assist with the purchase, or private company that buying other businesses. There is a handful of them here in Hawaii. Business brokers, like 1, maybe 2, I don't even know. We engage the M&A firm from the mainland that actually takes the client through the process of transition and sale. But EBITDA need to be consistent at $1 million and above.
Can EBITDA be derived from backing out the owner's?
It is a part of it. So when you said earlier that is optimizing your financial, actually you're putting everything back in. Now the question is that owner a crucial part of the business? Do you need to hire someone who will replace that business owner? Because if yes, then you need to give that new person salary, market price salary, so that will reduce the owner's salary. So it depends.
Yeah, no, we're actually structuring, just as an example, that the company will run itself. We're now passive. This guy worked his ass off for years. But now, neither of us have to go in. There's managers, and managers.
So
$1
most
million
likely
for the
both
manager.
of your salaries will be put back onto your adjusted EBITDA and
Salary, bonus, dividend.
all the retirement funding, everything that you use in the business to fund your personal.
That's a good example. You're a C Corp, so for tax efficiency, you need to take it out to minimize the double tax. That's kind of been how you go for tax purposes. Perfect, you should be doing that.
Yeah,
When
yeah.
you get ready to sell, you go to Ethan, you tell him your financials,
Opens
says here's
out.
where it's at, and he
That'll
confirms that you can work without these salaries. They're not necessary in that way. They are for tax, but not for traditional go, and you'll get a better result because it'll be added back to the.
Yeah, we structured right now. Yeah, that's a win. Interesting.
I'd like to mention one thing for folks that aren't in the position where they don't have to go in. And your exit plan, like Mark was saying, sometimes is a sale to somebody in-house and it's over time, and you can start immediately. For folks that are heavily involved in the business, your exit plan, it's not unheard of for you to sell to a third party, but what's going to end up happening is the third party is going to say, okay, we buy you, but you got to promise to work for another 4 or 5 years to make sure that this thing is transitioned to somebody who can take over. So your exit strategy or your exit timeline might end up being longer than you expected, and that last part of it, after you've sold, you might have a bunch of cash in the bank, but now you're working for somebody else, and you may not be used to working for somebody else. And so all these things need to be thought about, and that's why I think what we're saying is, even if you don't think you're going to exit for 10 years, it's important to start thinking about some of this stuff now and planning for it, so that in 10 years you can be in a position to actually achieve your financial goals.
I just wanna ask one more question for Scott, because it's very important to talk about the terms that goes into the agreement, especially if you're transferring internally within the company. So Scott can maybe talk about the terms that usually go inside it. What are those legal agreements that you might come out of the final sale and transfer to the employee or partners?
Sure, I mean, you obviously have a price, you've got, a timeline for them to pay it off over time, of how is it gonna be financed, usually using the company's cash flow, and, it's possible for you to pull additional funding out by way of going to a place of, I'm not working anymore, but I'm still drawing a salary or a bonus, or, you're funding my retirement
Benefits.
account, insurance benefits, those kind of things, those can be add-ons. And again, there's gonna be a non-compete typically, because nobody's gonna wanna buy your business if you're heavily involved in it and you understand it. If you could shut it down or go away and open up something else to compete, or go work for one of the competitors, so you'll have to sign a non-compete typically, usually 2 years to 5 years, depending on how involved you were with the business and how critical you are.
Employment agreement?
Yeah, you could have an employment agreement, like I was saying, to continue, in addition to getting the purchase of the company, maybe that purchase price wasn't the amount you wanted, so you still need to draw funding, so your salary, bonus, and stay on health insurance. Yeah, so.
Any questions when it comes to that?
And I can't say if you're thinking about a sale to a third party, and say it's a fund, a fund that buys companies, they're gonna want reps and warranties, and they're gonna want you to promise that your financial statements are correct. They're gonna want you to promise that your contracts are good. They want you to promise that you don't have any lawsuits or litigations or things hiding in the background. So you need to just have, that's why organization, being prepared, understanding these things, figuring out what the warts are, and figuring out with somebody like Marco or Ethan, how do you present the warts in a way that doesn't look bad. But you've got to disclose everything, because you will be required personally, because you're the owner, to sign off on these reps and warranties. Nobody's going to buy you without that. And you may have to stand behind some of the reps and warranties with some kind of, leave some cash back in an escrow, because you promised that you owned all this stuff, or you promised that everything was good and kosher, and something goes wrong later, they're gonna want some protection. So you can get more money sometimes if you sell to a third party, but there's a lot more handcuffs on you when you do, and it's a lot less handshake and we trust each other thing. It's very legal and
Straightforward.
yeah.
So just when it comes to the third-party sale, what we usually see, most of the time you do not get 100% of your money upfront. There's no way. Regardless who is selling, is it a fund, a private equity group, or is it someone who is in your business that is kind of want to have exposure in Hawaii and they're buying your business because they're doing something similar somewhere else. Most of the time structure is you get a 40% of your cash upfront. Then what they do, they pay off your liabilities if there is any liability, so they take over that note. So that's a portion of that selling price. They also roll you up into the new company that they formed that is actually now owns your business and your shares, so they give you a certain percentage, maybe 10, 15, 20% of the new company. And then the remainder of the money is usually like 3 years or 4 years employment contract with all the benefits. So we rarely see that someone actually writes the check and gives you, you want $1 million, here's the $1 million, thank you very much. Unless you plan ahead of time, you have all the bells and whistles in place, they don't need you in a business at all, you will be actually hurdle if you stay, you have a management team ready, then you're increasing the chances that you're going to get more money at the moment of signing. So just something to think about, especially with the C Corps. By far, C Corps are the hardest to transfer just because of the entity setup. LLC is probably the easiest. That's why a lot of people are keeping it LLC, because they want to eventually sell it. They want to make it easy transaction and transition. For internal, we love S Corps, because S Corps helps business owner actually increase the amount of money, how much they can pocket because they retain certain percentage of shares for S corp distributions. And that's pretty much it. I want you today to kind of take home and says planning. Start thinking ahead. Doesn't matter if it's 3 years, 5 years, 7 years, 10 years. Just get your ducks in a row. Doesn't really matter when. Just start thinking about it ahead of a time. Because I honestly, once you open that thinking in your head that you want to get out one way and you start thinking in that direction, a lot of stuff change over a period of time.
So what's your process, Marco? Say, Bob and I give you a call and say, we're interested in pursuing this. What do you actually do on your guys' end? The four of you sit down with us, we have coffee, we kind of lay out the broad thing and just have
So the first step
BS
is
session.
actually before we go to everybody, we're going step by step, so not everybody involved in the same time. First is you meet with us, we assess the situation, we gather all the documents, we do the business assessment. We have a tool that does the business assessment that will actually set all the priorities, what need to be done. Then we send you engagement letter, and then once we get engaged, then we start the process. Up to that point, we gather all the documents because we signed the NDA. If you say no, we don't want to proceed, everything gets shredded. If you do, we already have the stuff so we know how fast we can move. If you have a CPA, this is crucial for all the business owners. Think about it. Do you have a CPA who is a planner, or you have a CPA who is a filer? So that will determine when we're going to see Charles. Right? So if your CPA is a filer, and he doesn't talk to you throughout the year to plan for that year, and he calls you in January and says, send me your financials, you have a problem. That's a filer. And you know, they maybe know all this stuff, but they don't usually share with you because you didn't ask them. Just think about it. Why? Because they don't have a capacity. They're usually one-man, two-man show. They can have a couple of hundred individual clients, and they can have like 10 to 15 business owner clients. That's it. That's a capacity. They don't have a time to talk to you. They're just doing their job. Now, are they aligned with your goals and plans of exit? I don't know. Probably not, because you never told them. How often did you put all of your advisors in one room to talk about you? How often? Never. And everything is left to you as a business owner to filter out and spit out with the next course of action. Well, with us is a little bit different. We just did one yesterday. Charles mentioned it earlier. The guy, when we first time sit down with him, was like one company, C Corp. $100,000, $200,000 name. Now, 3 companies, and like Charles mentioned, I don't even remember, like 1.2, 1.3, or 5, I mean, like, he's killing it. Different planning. And guess how much we told him yesterday that he's going to end up paying in taxes for 2018? On top of what he estimated already? Additional, how much, Charles?
No, it's not.
0. So, people come to us, we engage, we talk, we create the plan, business assessment, then we introduce you to CPA. Charles and I are the people that will be with you for a long period of time. Ethan gets engaged in a step 2 to do business valuation, quick one for now, and then maybe later on, 3, 4, 5 years, we bring him on board again, because now it's time to sell it. We need to know where we at. Okay, Scott, once we develop the plan, and we talk to the business owner, we have all the terms written down. We call Scott. Scott and Charles comes in. Not this Charles, his Charles comes in, or whoever else. They come in, and then we start writing the documents. Do document change? Potentially, if they start bringing more people on board later on. We have that happened before. So that's kind of process. So who actually stays with you for a long time is us and a CPA.
Good explanation, thank you.
Okay, appreciate it. Any additional questions?
When can we pick up our money?
Michelle in the back, she has your checks ready.
Done.
Well, I just want to make sure that you open your folder. Spend a few seconds by doing that. We put some stuff inside, so I would like you to know what's going on. On your left side, you will see 2016 BEI Business Owner Survey Report. That will just reconfirm that you are not kind of like on your own here in Hawaii. Actually, everybody in the United States do not plan for exit, so it's not only you. So it's kind of like good thing or bad thing, right? You will also find out a little bit about our bios. You will also see our services that we provide in the whole process of exit planning. Another thing that you're going to see is the little survey that we will appreciate if you do survey. That's a business exit assessment survey. It's only 6 questions, I think. Put your company name on the top, please, and then like just for your own sake, answer those questions. And see where you're at. And Michelle will go around and collect that from you before you leave. That's your ticket out. If you don't have any other questions, I would like to thank you all for coming today and spending this breakfast morning with us. If you have any questions, our information is inside. Please contact us. We do not charge you for those first initial interviews or conversations. We live in Hawaii, so we are pretty flexible. And that's it. Thank you.
Thank you.